Amazon. Does this stock still have room to run? Let's find out on the Brew. Hello,
Good
Mom.
morning.
Oh my God. Look at you. You're all bright and bushy tailed, all that kind of good stuff. How are you?
Good. How are you?
Good. I am not, on the other hand. I just blah, blah through the opening. I did a blah, blah.
Well, I am on coffee this morning, so let's harvest my
Yeah, I got I got to drink this whole jug of water today.
You're hydrating, I see.
Mm-hmm. It's my new thing. Okay, Amazon. Yeah, sorry.
Right, but before Amazon, I have big news. I just got a Keurig and I found K-Cups with bulletproof coffee K-Cups. It's like mind-altering. So they have MCT oil and
okay, I can get that at the Costco.
Yeah, you get it you get it on Amazon.
Or get it on Amazon's. All right, we'll do that.
The Amazon
machine. So incidentally, Amazon's on our lips. We're going to talk with Paulina on Friday about Amazon as well. She's bullish on the stock. I think I'm bullish too. I mean, I'm not a big direction picker typically, but I'm a big user of Amazon, and I'm reading the book, The Everything Store. I think that's what it's called.
How is it so far? Good?
Oh, it's great. Yeah, the guy's amazing. That's that Bezos guy. He's gotten a little loony, but a couple $100 billion will do that to you.
Well, listen, I'm getting my pilot's license, and divorce is horrible. But anyone, his wife is a helicopter pilot, so she's okay in my book. But I think
you're getting your pilot's license.
I am getting my pilot's license.
Okay.
My dad was a hobby pilot. He had his instrument rating.
Cool.
Excuse me. Technical difficulties. So I think the thing to remember about AWS is that Amazon has different services, and part of it is cloud services under AWS. And I think the thing to remember with them is that they host majority of cloud services, so including SIBO. So every trade you do is, I love Boo. There he is, right behind you.
Yeah,
so cute.
She'll start barking any minute. So
they're completely hosted on AWS, and I think the thing to remember that the service that they're providing is that they're every company's dream, which is turning a fixed cost into a variable cost. So normal companies are hosting on their own, private data servers, and so that they pay for it whether it's being used or not. Where AWS is scalable, so you can grow, you can shrink as your customer base, especially if you have a seasonal architecture of your sales and cash flow. So I think the thing to remember is that, however, one must also look that it becomes a little bit dangerous that we have all of our eggs in one basket. And so one click of a button, let's say cybersecurity is breached, it affects everyone across the world. And I think they're definitely over 30% of all cloud compute, but they're the fastest growing tech in the world. And that is something to keep an eye on. The other thing is we had 2023 AWS reInvent. So we're going to I won't do it here because we want to get we want to get you actionable news and get Lex to give you a trade. But one thing that we're going to go over on Friday is NVIDIA's announcement with AWS and Amazon, which is they are teaming up and they're using NVIDIA's chips. I think NVIDIA has 3,000 supercomputers on AWS as we speak, which is just insane, but nothing compared to an actual quantum computer, which comes into play when we talk about cybersecurity in the future. And then, of course, they announced Q, which is their AI. So that's something to look at. Yeah.
So they're going AI. AWS has been one of their bigger drivers of revenue, right, of late.
Yeah.
And I'm trying to look quickly at what it accounts for 14% of Amazon's total revenue. It's pretty big, right?
And
So
that's gonna grow. That's gonna skyrocket.
yeah, I think that's
Yeah.
what the folks are thinking is that number is going straight north. That
Yeah.
translates into about $21.5 billion of the total, like 157. So that's pretty amazing, right? And as you said, firms like the SIBO, which is the options market in Chicago, they use AWS. You said, right?
Yes. And
So
so they just in 2022, SIBO just added an arm for cybersecurity. So I'm interested to see where they're going to head with that. And
mhm.
also in 2020, January 1st, coming up here, 2024, they're about to test T+1, which is just a faster clearing and settlement. And so this thing is picking up speed quickly, and we will keep you in the loop as it unfolds
Okay,
here on the Brew.
here on the Brew, let's do a trade. What do you think?
Okay, I love it.
I'm not sure I have a trade yet, but let's look at it. Okay, here's we're in Trade Hawk. I've got Amazon up here on the chart screen, majiggy. And I'm looking at Amazon in a daily chart over 522 days. So you can see this trajectory. If I actually had a drawing tool, I would be able to draw on the screen, but I don't.
Guys,
So,
boys, Ruben, Max, Diego, Luis.
holy cow.
We gotta
So you can see
find him a
this.
drawing tool.
That's right. Give me a drawing tool. There's a run up here from way back in March, when we hit this low here, all the way up to current prices right now. So that looks like, I don't know, that's about 90 up to 146, 147 thereabouts, right? So that's quite a move. Anyhow,
Yeah.
that's pretty impressive. So what I like to look at for these trades, I'm not a super great directional trader, but someone whispered in my ear and said, Amazon's going higher. Okay. So I have it on good authority that this person thinks Amazon's going to continue higher. What do I do? The way I like to do this is I like to see implied volatility first. Okay. So all I did was check that on. That blue line is implied volatility. Okay. I don't know if you can see that, but that blue jaggedy line is implied volatility. Now, implied volatility, just so we're clear, is taken from the option prices. So it's a future indication of what the options markets think Amazon volatility will be. Okay. Now you can see this blue line down here. It looks like it's low on the scale, right? Because it goes way up here at times and it goes way down here. So what I see in this over the 522 days or so is that Amazon had a high implied volatility of around 60 close. And guess what? It is at the bottom of implied volatility here at about 22-ish, let's call it. Okay. So first thing is there's low implied volatility. The markets are thinking Amazon's not going to be very volatile in terms of its movement, right? So that's a big difference, 60 to 22. Okay. So I know implied volatility is low. We can get more granular and figure out if implied volatility is low based on the movement. So I added in a close to close historical volatility. Okay, that's the red line. Now, historical volatility is realized on the underlying stock. That's backwards looking. Implied volatility is more forward looking. So what I like to do, if I can do this, is when implied volatility is lower than actual, I like to figure out a way to buy implied volatility. Okay. Am I going too fast? Does this make any sense?
No, how would you speak to being careful of outliers? So, if there's a big swing outside of the norm, outside of a historical metric, how do you work with that?
Yeah, so that's a good question. So when implied volatility is low like this, it's going to cause me to buy it. Okay. It's not my favorite activity, buying premium, buying volatility. I don't generally love it. But what the big takeaway here is don't get caught in the trap of selling cheap stuff and buying expensive stuff. Now, someone's going to say, who knows this really well, well, wait a minute. What if expensive stuff isn't expensive enough because actual is even higher? That's a good point. Okay. We're not going to get to that granularity in this show today, but that's a good point. Okay. So you can make an argument. Is it low enough relative to actual? Well, we've just proven that probably not. Actual is actually much higher. So it's around 33 actually, and implying 23. They're 10 points difference. That's pretty cheap implied
Yeah, and
volatility. I
just
haven't seen it this low.
Yeah, and just to speak to what you were saying before, whether it's, being held down, there's a great little clip of Bezos talking about, when this stock dropped to $6 at that one point.
Yep.
And he's like, he looked inside, he's like, I'm watching the stock drop, but I'm looking at all of our metrics jump and
Hmm.
improve. And so, there you also, I really, as a fundamental trader, I always like to just take that balance sheet and see if
Right.
it's strong, take that cash flow, make sure it's looking healthy.
Yep.
And anytime we have an outlier too with this.
Right. I like it. So what am I going to do? Right. Here's what I'll tell you what I'm going to do. Ready? So my first metric is to look at implied volatility. See, is it cheap or is it expensive? Right. So cheapness, I got to buy something. I got to get long Vega. Unfortunately, can I offset some of that theta that I'm going to get? Maybe, maybe not. We'll see. So what I chose to do, and again, someone told me that they're very bullish in Amazon, that there's a big upside, ability here. So what I put up here is a 9-day December option against a 44-day January option. Okay. So I want to be long Vega. So what I did back in January is I'm protecting my downside with the January position. I'm buying 2 lower strike puts. I'm selling 1 upper strike puts. That's called a back spread. I'm buying 2, selling 1. I have an extra unit so that if this stock falls out of bed, I have that extra put to protect me. Now I have a little trouble between 135 and 130. I'm not worried about that. I've got time to deal with it. Okay. So this is my protective little bit of the spread. This is a 4-legged spread, by the way. Okay. So
And
that's
the difference between the 135 and 130 is that inside of your risk
yes.
parameters.
For me, it is. So,
Okay.
when we get to the whole, back end of the spread, you'll see what we can lose here. Okay. As a max loss. So I've got that extra put. Now, what I'm going to do is I'm going to place a long upside spread to take advantage of what we were told someone believes that Amazon's going to really motor higher. Okay. So all I did in this one is I just bought a synthetic long stock in the D15th, 9th, 9 days to go expiration. What does that mean? I bought the at the money call. I sold the at the money put. So I'm buying premium. I'm selling premium. It's going to net out to be about 0. But that spread is called synthetic long stock. So I'm buying options. I'm using options to create a synthetic of the underlying stock. Okay. So I'm long the stock using options, right? There's no Vega to that component. It's just all delta. So I've got a
And
long spread and I got a short spread. Go ahead.
And synthetics is really great because it lowers the barrier of entry. You don't have to go and buy that expensive stock.
Yep. It helps a lot. It's a big play.
Yeah.
But don't forget, if I'm synthetically long this stock, I'm short a put naked here. But don't forget, in my back month explosion spread, I've got an extra put. So I'm net flat puts here. Okay. So that's beautiful. I love that. Let's take a look at this, what this looks like on a risk graph. Okay. So here's a big risk graph, right? Now, our task was to gain value to the upside. So you can see we have infinite upside exposure to make, right? Not exposure, but P&L potential. So the risk reward here is pretty good. I love when I see the word infinity for my maximum profit. That seems like a really big
We
number.
need a shirt, guys. We need a shirt for that.
Yeah, infinity. What's your max
shirt.
profit? Infinity. And then my max loss is $2,000 on this spread. Okay. So this is pretty good. I don't mind this. Yeah, it's not so bad. And guess what? Remember I said I want to be long Vega? Look at my Vega here. I'm long 5 Vega. Now I just did 1 lots here, so we don't get creeped out. So I'm long Vega, right? I'm long a little bit of gamma. I'm long a little bit of delta as well. So I'm pushing myself on the long side. Why am I long the Vega? Because remember we did the analysis of implied volatility. It's really, really, really cheap. You have to buy it, unfortunately. I don't like buying things because when buying premium, I should say, because that has a theta effect. So it's going to cost me a little bit of money, $3 a day, $3.50 a day. But I get myself in a good position. If volatility goes up, I can make some money. My risk is to the downside, but we knew that going in. We knew that we were going to have risk to the downside because we wanted to get long. Could I fix this? Of course I could fix this. I could do a 2x1 put spread, or 3x1 to fix some of that downside. I could add an extra put to this thing, that will add more premium and more Vega. And it's a decision, as a trader you can make for sure. Now, real quickly, and we're going to end here soon, unless you have some questions, which you probably do. I've got expiration issues. So in 9 days, this is going to expire. I would get long stock, actual stock, if I don't roll this. So the process is to go out after this, as this is coming near, is to roll this out to the next one. And then when this one comes near, roll it out to the next one, and so on and so forth. Right?
Okay.
Until I get out to my Jan 19th. And I may, if I'm still in this and I want to keep doing it, I can keep positioning my put spread farther and farther in time. Another good question. Why don't you just do it from the beginning? Certainly can do that. Okay. Depends on your time horizons. I like to work in 30-day increments, right? So I got a 44-day up here. I got a 9-day expiration. So it's kind of fits into my scheme of 30 days. I like to stay near expiration within 30-ish days and keep moving things as time goes by. Does that make sense?
Yeah, absolutely. And then, their rolling is always expensive. So how do you mentally prepare for that? And how do you plan for that?
Rolling is not expensive at Tradier. Here's a plug. That's a plug.
Wait,
because
let's harvest that plug.
Let's harvest the plug because we don't pay commissions on options. So I'm not paying anything to roll this stuff. So my commissions are, except for exchange fees and all that kind of stuff. So that's baked in. So my commissions are easy here. I don't have to worry about too much trading. I'm not advocating, massive amounts of trading. This is a position. I'm going to hold this, right? Because I have a belief. Someone said you got to get long Amazon. I'm doing it with options safely. I'm protecting my downside without just being naked long. So now you could ask me, well, why don't you just get long a call? Good answer. Good question. But when I'm long a call, I'm going to get that bigger theta. So this is a way for me to mitigate some of the theta with low volatility. I love 2x1 back spreads, buy 2, sell 1. And if you can get one 3x1, 4x1 with credits, great. When volatility is cheap, you can do these 2x1s and get great prices for your 2x1 without paying much for it at all. Okay?
Yeah,
so
can we call it 2x1 a twofer?
It could be a twofer. What about 3x1? A treefer? You got a treefer and a twofer.
Okay, so I have a two comments. You know me,
Yes.
I can't stop talking. So
Okay.
you have a lot of Amazon employees sitting on stock options,
Oh.
and they don't want to get rid of them. They believe
Right.
in the company, they work there. What's a quick play you would give all of those Amazon employees that don't want to ever get out of these, but want to collect a little rent on the positions that they hold?
Yeah. So when you say options, those aren't.
Sorry, not options, right? Stock options. So the difference
which
is important to know.
Right.
Yeah.
If they're options, they have strike prices. So, these things are probably 10, 15, 20-year long stock options, right?
Sorry. So this is actually really important. We take this for granted, but to know the difference, because when you start to jump into learning options, you're like, well, options, is it a stock option? They're different, but they sound the same. So this is a great explanation.
Yeah. So if these employees have options, I'm assuming that they haven't exercised them. The reason that they haven't is because there's a tax reason, first of all. So when you exercise something, you have a strike price and you have your cost basis is down here. When you exercise for that strike and the stock is trading at 145, 46, you're going to realize that difference when you exercise those options. Now, all of a sudden, you have a taxable event.
Good to know.
Okay?
Right.
So that's a taxable event. So what most people do is they keep their options as options. They still have the value. It's the difference between that strike price, which is probably really, really low for them, and the current price. That's their value, right? So you might as well keep them in the option form and don't exercise them because of that taxable event. Now, you're going to say, well, people exercise them, right? Jeff Bezos exercised them. Well, that's for managing his some of his portfolio and for also managing cash flow, because you can't really do much with an option in terms of paying the bills. You have to put that into stock and then sell it so that you get the cash and therefore spend it. Now, you can also borrow against your stock. All that stuff's very liquid and all that kind of stuff. We won't get into that now, but that's what happens. So if you're an employee and you own the option, you're in good shape. If you exercise and take delivery of the stock, you're in different shape. Now you have an asset that's $146 that can go up and down. You have no protection to the downside. You don't have that strike price anymore if you exercise. So what a lot of folks do, Mark Cuban did this beautifully with Yahoo stock. when he got their stock for his company. He did a collar. Okay. And I'm going to do it on the screen. Can we go back to the screen real quick? And then we're going to end on this one, right? So typically what people do is they go out in some time. I'll go out to 60 days. Actually, I'm going to go out to 100 days. Okay. So I'm going to look at a March option. So I'm in March. Now, if I get stock at 146, I want to protect the downside. You've got to decide how much you're going to protect. Are you protecting 10%, 20%, 30%? That's up to you. But what I like to do is I like to find a set of options. Let's say I pick the 130 as my put. I'm going to buy the 130 put. Okay, it's $3-ish, right? At the money's 145. And I'm going to go up, it's 15. Let's go up 15 as well, see what we get. I'm going to go up to the 160 as well. So I'm going to sell that call. This is called a collar. We are protecting long stock. So we have a long put and a long call. Why do we do both of those? You don't have to, but we're trying to get this for no cost, right? Or if we can get a credit, we love it. So I've got a credit of $1.45. So I'm protecting my position here. Let's take a look at what this looks like in what if, because this is going to be a short delta play to protect your downside. So notice what happens. I've got all this spot here where I'm just making a little bit of money. Okay. I'm losing to the upside because I'm short that call, but don't forget I'm long the stock. I've exercised, right? So I don't have that in here right now. And then my downside is uncapped. It goes down forever to protect, right? So what we're trying to do here is we're trying to protect a zone of my Amazon stock when I exercise it and take delivery of the stock. Okay. Does that all make sense, Mal?
Absolutely. This is great. So, this is you can actually use trade hawk. So let's say you want to take position of those options. You can actually, set reminders or set limits that notify you when it drops to a certain price and you're ready to get out.
Yeah. So, right. So what happens with these collars when an employee or someone owns stock in something and they're not trading this is just protective. They've made a decision to protect their long stock. Okay. So I added the long stock here. You can see how that changes. Look at the graph now. I have a defined downside. So I've protected my downside. I have all this value in my stock, and I'm willing to give up $1,400 in this example because I chose the 130 strike or 135 strike, whatever it was. And that's where I put it. You can move these around, and you can get different parameters. You can get more aggressive or less aggressive depending on what your thresholds are. But notice now, I've got good upside, and then it's capped as well because I'm short that call. Right. So with the stock in here, I've got good upside potential, but I'm capping the downside, capping the upside. I've called it a day. This is where I like my stock. I'm protecting it. Okay. And you could take out the call side if you wanted to. Now you're going to pay premium and theta on that, just that naked put. Okay. Does that all make sense?
And you can't, and you can do this every month, and you can just sit on you can just collect a little crumb collection of change every month.
Right. And the beauty of this is if you're gonna do this spread for a credit to collect money, it probably makes a little more sense to do it more frequently, keep collecting that money, right? Each month or each weekly, whatever they have, and putting that in your bank, and then just keep rolling it. Just keep rolling your collar month in and month out, or week in and week out, as the case may be. If you keep getting credits, wonderful. Remember, this is a protective strategy on something that you already own, right? So you've already taken this delivery of this stock and you're protecting it. This is the classic way to protect this thing. And you as a user can decide what percent down, what percent up you're going to protect and go to town. And there's all kinds of variations of this we can talk about in the future. Cool?
Cool. And then tomorrow, don't miss the boys. They're going to go a deep dive into a really technical position, probably around Amazon. There's some competitors. So on the cloud, I'm just keeping an eye on the cloud services because of reInvent that just happened. But we have Microsoft Azure, Google Cloud Platform, IBM Cloud, Oracle Cloud, Alibaba Cloud. So everyone's getting into the business and has been in it. I mean, obviously, this is where we're all going. But I wonder. There's analog may be the future. Down the road when things become a little bit fragile. But that's just me putting my
there you go, CT. That a girl.
All Thanks, right, Lex. This is great.
Let's stop there. No, that was fun. Don't forget to make comments down below if we can do that. I love questions on this stuff. This is one person's opinion on a certain spread. There are many other ones I could have come up with.
And not advice. This is not advice.
Not advice.
This
Not
is,
advice.
yeah.
Yeah, can't say that. Options are awesome because you can do so many combinations of things. That's another big takeaway, right?
Yeah.
So anyhow, all right, good show. We'll talk about it with the guys tomorrow. We'll do a little bit of Vana and Charm on 0 DTEs. Ooh. And we'll talk a little bit about Amazon. There's a straddle swap kind of idea we're going to talk about tomorrow, so we'll get into that. And then Paulina is going to talk about Amazon on Friday. So it's Amazon week, I think,
Really cool.
Go buy something. I bought a suitcase today.
Where are you going? Where are we going?
Vegas.
I'm coming with you.
You're coming. All right. Anyway, have a good rest of the week, Mal. Good to see you. And I'll see you next week.
Bye, Lex.
Bye.